Our next speaker is Rob Promisel. He is a senior member of the portfolio management team at Resolution Capital. They manage the Nedgroup Investments Global Property Fund. Resolution's disciplined investment process emphasizes a global sectoral perspective and focuses on long-term wealth preservation and appreciation. Resolution Capital is a global leader in their commitment to responsible investing, as well as industry participation around the sustainability agenda. Hi, Rob. Nice seeing you again. How are you doing?
Great, Anil. Happy New Year.
Yeah, and to you too, eh? All the best for the 2025.
Here's
Still
to a good
enjoying
one.
New York?
Yes, I am. Thanks for asking. It's
Brilliant.
cold.
Yeah, I think, yeah, we're having much better weather here in Cape Town, fortunately. Rob, I just want to get an update on the portfolio, please, for all of our clients dialing in today. Shall we spend a bit of time on it and dive in?
Let's do it.
Okay, great. Thank you so much. So the first one is just about performance. So, as you know, Q4 was a little bit rough for the asset class in general last year. Fortunately, the full year results were a lot better. And can you please just talk us through it?
Sure. Real estate was pretty well positioned last year with improving operating margins as utilization went up, occupancy went up, and landlords were able to raise rents at or above the rate of inflation for many property sectors. There was a change in fortune in the fourth quarter, not operationally, but more from a sentiment point of view, as we started to see real interest rates go higher, and the expectation of interest rates cuts started to dissipate. And that caused, we think, more of a change in the multiple for the stocks than a change in the operating performance and earnings outlook. And so that really weighed on the sector as we see it. If we were to dive into on slide 3, really what drove performance and positioning by sector and by market, you'll see that really data centers and industrial were strong contributors, and healthcare were strong contributors to the relative performance we saw. We had some positive relative performance in a down market in the fourth quarter. Data centers are really in the midst of a strong secular growth story. This portfolio was significantly overweight data centers. Industrial is moving on to a period of normalization where outsized rent growth that was experienced post-pandemic is slowly giving it back. The portfolio was significantly underweight data centers, and so that contributed to performance. And then healthcare, really driven by seniors housing, continues to be a very good grower overall, and the portfolio is significantly overweight healthcare, with the largest position being senior housing leader Welltower. And then a top 3 position also is Ventas. On the bottom end, you'll see that self-storage detracted from performance. The portfolio, for the most part, was about market weight self-storage, but within that self-storage universe was a bit more nuanced. The portfolio is overweight self-storage in the UK and Europe, where we find that the supply per capita is pretty low. And it was underweight self-storage in the US, where there is a fair amount of new supply and where landlords really just don't have any pricing power. So that's how we were positioned. In fact, the UK stocks, Big Yellow and Safe Store, were poor performers during the quarter. Really, the UK overall was a poor performer, as we'll talk about in a bit. Whereas in the US, the underweight actually ended up working out okay. Residential also was a negative contributor to performance in the fourth quarter, and that was really kind of across the board in terms of rental housing. We saw in Canada, Canadian apartments struggled as a stock. Those are mostly regulated cash flows, and in a higher rate environment, that long-term cash flow came under pressure. The same could be said about Germany. And of course, the change in regime in Syria is expected to see some reverse out migration of Syrian refugees that were living in Germany, and so that's also weighing on expectations for the German residential stocks. And then in the U.S., Sun Communities, which is a manufactured housing stock, continue to disappoint, even though they are now going to take on some changes in governance, looking for a new CEO and also replacement of board members. That's really the story from what drove performance from a sector point of view. You see on the right side of the page, the U.S. was a strong contributor to performance. That's where the data centers and healthcare names are really located, as well as the underweight in the U.S. with Prologis as the largest REIT, the significant underweight there. And then you can see the U.K. where the portfolio finds good value. Those stocks really struggled in the fourth quarter.
Thanks, Rob. And just something which you've started talking about already, but the current positioning of the portfolio and overweights, underweights, and so on. Can you please talk us through a bit about that?
Sure. You see on slide 4, the portfolio maintains significant overweight in healthcare. And mostly that's driven by seniors housing, as I talked about. We think we continue to be on the front end of strong demographic-driven demand because you have the aging baby boomers that are now just turning 80, which is a typical move-in age into purpose-built seniors housing. Welltower and Ventas, two of the largest owners of private pay senior housing in the U.S., also have exposure into Canada, and in the case of Welltower, also to the U.K. And the demographics in the UK and Canada are even more compelling from a baby boom aging into a renter age than they are in the US. And there's really no supply. That's a thematic that I think is important to be mindful of for commercial real estate in general. We see the supply pressures lessening prospectively because there really isn't the traditional construction finance available. And so you may see some cranes out there in whatever city you're in, but trust me, there's far less speculative construction going on across almost every asset class than there has been. There are far fewer starts, certainly. And so what you are seeing under construction, when that completes, we think we're going to hit a window where there's very little new competitive supply coming on. That's true for seniors housing. It's true for retail, where there's been no new retail construction in the U.S. for many years. And retail is the largest sector exposure for the portfolio. It's very much necessity-driven retail. So in the U.S., it'll be community shopping centers that are anchored by a grocery store or a drugstore that are an outdoor format, as compared to enclosed malls, which are much more of a discretionary spend because they're more apparel and fashion-oriented. It's a little less true outside of the U.S. and markets in Europe, where we have exposure to Unibail and Klépierre, as well as Australia. We have exposure to Scentre Group, which owns the Westfield brand of malls in Australia. In those cases, they have less competitive supply, meaning less retail square footage per capita, and also their enclosed malls incorporate necessity shopping by way of having supermarkets. And so that's really how the portfolio has been positioned. You see that healthcare and residential collectively comprise about a third of the portfolio. That's shelter, that's housing. Healthcare, seniors housing is very much a niche, specialized use type of residential. And then residential, as we categorize it, is rental housing. And we find that there is an undersupply of rental housing over the medium and long term. And so that means that utilization for rental housing, meaning occupancy, is expected to remain well in the mid-90s, providing landlords with visible rental power over time. Data centers is a significant overweight for the portfolio. We find that there is a very strong demand, and we expect this to continue based on the CapEx plans for some of the major cloud providers like Microsoft and Amazon Web Services. And as more and more of the economy moves into digital form, as more and more uses for efficient digitization through AI grow and expand throughout all of our daily lives over the coming years, we expect demand for data center usage to continue to be quite strong. And importantly, what we're trying to do is we're trying to invest not just in landlords that have an interesting thematic, but in landlords that can actually make money off of that thematic. And one important consideration in real estate, more broadly than data centers, is we're looking for a mismatch between demand and supply, particularly where demand is much stronger than supply. And so in the case of data centers, we have, it's pretty clear that there's going to be very strong demand going forward. But critically, there are constraints to supply, and there are constraints to supply that you wouldn't normally think about for commercial real estate. In particular, there are constraints on the energy provision side. Data centers use quite a bit of energy, and we find that a number of the utilities just are maxing out their capacity over the next several years. And that is creating a very practical limitation on competitive supply for data centers.
Sure. Wow, that's all very, very interesting. And Rob, I guess just the last time we chatted, you did mention about there's quite a lot of dispersion across sectors and across regions from an implied cap rate perspective. So can you talk about that in a bit more detail as well, please? And does it potentially mean more opportunities for active management?
So we think that the implied cap rates, which basically the implied cap rate is the cash flow divided by the value of the enterprise, the income yield, if you will, before CapEx. We find that the implied cap rates are a bit higher than they were during the pandemic. And this is actually consistent with what you would expect in a higher real rate environment. One thing we did over the past quarter was we increased our exposure to office stocks. You'll see offices are at a 7.5% implied cap rate. We find that that's actually good value for the growth profile going forward. We expect in a strong economy, such as we see in the US, in an improving economy in other parts of the world, even like in Japan, for instance, where you're seeing signs of economic growth picking up for the first time in generations, find that we expect the cash flows from office portfolios to grow really for the first time in several years. And so we're a bit more constructive there. So we find that that implied cap rate is attractive. Data centers and healthcare, you'll see on the slide, are at the lower end at just under a 5% implied cap rate. But we actually think that you're going to pay a higher multiple for stronger growth. And we actually think that healthcare and data centers are going to deliver. In the case of Welltower, again, the largest position in the portfolio, we're expecting senior housing NOI to grow at over 20% a year for the next several years based on continued growth in occupancy as well as pricing power. And so the idea that you're paying a 4.8% implied cap rate for that type of growth is really quite, it's okay in our mind. We find that that's still pretty good value. If you look at it regionally, one thing I point out is that the Hong Kong is really come off quite a bit, and capital has flown away from Hong Kong. The companies haven't done themselves a lot of favors in terms of disclosure and really how they've set up their business enterprises in terms of reliance on condo sales and whatnot, and the lack of significant recurring cash flows. But that's been a real challenge, and the portfolio is a significant underweight to Hong Kong, almost more of an underweight than any time in over 10 years. Japan is interesting at a 6.8 implied cap rate, given how low real yields are in that market. We find that that's good value. And then the UK is trading a similar implied cap rate as Japan, but This is high for the UK historically, and we find that there's value in the UK, in the UK property stocks, which have actually stable operations. But there's no love right now for the UK market.
And Rob, what about the UK market specifically? I mean, there is so much going on there. You already mentioned about some of the interesting positions you have in that region. What's been the impact of the recent yield changes?
We find the UK market has some of the highest real interest rates in all of the markets that we invest in, and that has discouraged capital from being invested in the UK. So that's a macro overlay that is overwhelming what is still a very good micro story at the property level and at the property company level. The companies that we've invested in the UK have balance sheets that have been largely de-risked over the past 10 years. So leverage is under control, maturity risks are laddered. There isn't significant competitive supply being constructed in the UK, with a few exceptions, and we've tried to avoid those pockets. So, for instance, in the office market in London, we're focused on the West End of London, where there's limited new construction and there's strong demand by tenants, and rents are rising. And we've avoided areas of the London office market where there's an abundance of supply, such as Canary Wharf or in parts of the city of London. We find that the operating fundamentals for the UK are much better than the macro story right now for the UK, driven really by a combination of high real interest rates, which itself is perhaps the outcome of disappointment with government leadership right now in the UK. We expect this to change, not leadership, but sentiment over time. And historically, what's really driven returns in our sector has been real estate fundamentals over the medium and long term. And in that situation, the UK is fine.
And Rob, just I guess the logistics sector is another very interesting one, post-COVID especially. So there's been quite a big impact on e-commerce and related industries. Can you please share your thoughts with us on that?
The portfolio is significantly underweight the logistics sector globally. And in particular, we're underweight the logistics sector in the US and in Europe and in Australia. We find that logistics had, if one could say, they had a very good pandemic, where demand from really e-commerce driven companies soared. You remember retail venues were shuttered for a period of time around the world as people stayed home and shopped at home, and e-commerce boomed. And you can see that on the chart on the left with the steep upward slope in e-commerce in 2020 and 2021. And now we've moved to more of a normalization of e-commerce demand. And as a result, we find that the leasing environment for the UK is moving down from what had been super tight conditions where I know in the greater Los Angeles market, which is the largest industrial logistics market in the US, occupancy had been, during coming out of the pandemic, had been over 99%, and space was being leased almost before it was seen. And we saw rents spike up in a 2.5-year period by almost 100%. And so now I keep using the word normalization for industrial. Occupancy has dropped about 300, in some cases 400 basis points, and market rents have fallen off of that spiked level that they were at. As a result, the embedded internal growth for the industrial companies is diminishing. And there will be a risk that, in fact, that the internal growth could turn negative. And so we are wary. we respect the fact that demand for industrial is going to play an important part in the economy going forward and in people's real estate portfolios going forward. But we're underweight the stocks right now as we anticipate there continues to be a recalibration of their internal growth profile as some of the supernormal demand cools. That's really what's leading to the portfolio positioning being underweight industrial. And that actually was the right move in the fourth quarter and contributed to relative performance.
And Rob, I guess just the last question for today then, just please, what's your outlook for the real estate sector, and where are you seeing the opportunities? Do we have lots to look forward to? What would you say?
I'm incredibly encouraged by real estate today. I know that it's a bit of an unloved sector in a world where we're navigating through higher interest rates. But if you step back and put that macro aside, and you just look at the durability of demand, the economies are doing pretty well, and real estate's demand for real estate is derived from by economic activity. And so we're constructive about the demand profile for commercial real estate going forward. And then you match with what I said earlier, there being fairly limited construction activity because there just isn't the construction finance available. Banks have pulled back due to higher risk-based capital requirements. The securitization of debt off their balance sheets is still not back fully functioning. So we just don't find that there's nearly as much speculative construction starts as there's been historically. And that is a very good setup going into 26 and 27 for there being less competitive supply. And so the outlook then, when you have stable to growing demand in an environment where there's less competitive supply, is that landlords should have pricing power, which should be able to drive earnings growth going forward. So pretty constructive about the operational setup. And then the capital structure for these companies has been significantly de-risked over the past many years. Leverage is controlled, it's low, maturities are laddered. And so the financial interest risk, yes, there will be an increase in interest expense as debt matures, but we just don't think that it's going to be all at once. And so the setup is one where the capital structure also has been de-risked. So we're pretty constructive about the outlook for real estate and think that where we should expect to see earnings growth in the mid to high single digits for many of these companies prospectively over the next several